There are so many myths out there on how to navigate the real estate market, what to do, so much misinformation. And today, Danny and myself are going to bust some of those myths, have some fun in the meantime. And if you like what you see, stay tuned.
So Lee, I know you work with a ton of first-time home buyers. One of the biggest myths in our world is that as a first-time home buyer, or in general, as a buyer, you need 20% down. I just wanted to kind of touch this topic for a few minutes because there are programs out there, if you're a veteran, for as little as 0% down. If you're not a veteran and you're a first-time home buyer, you can put as little as 3% down or 3.5% down. In this market, we're seeing tons of seller credits. It's becoming more of a buyer's market. And we also have seen an uptick in competitive down payment assistance programs. So we've had a lot of scenarios where you, the client, has been able to get into the home for first, last, and security or less, depending on how everything is structured, not only with the loan, but with the offers as well. So I just wanted to point that out because we're seeing tons of opportunities in this market where customers that may not think they have the opportunity to buy really have far more than enough than they need.
I think that that's where the value of a agent and loan officer partnership comes into play, is that there's so many myths out there on what it takes to buy real estate. There's a couple things that everyone thinks that they're experts in: politics, sports, and real estate. And working with a fiduciary who understands how to represent, who knows how to navigate the market, a question like this is really a ball on a tee that we could just knock out, which is the reason someone should own real estate is that as long as they can afford the principal, interest, taxes, and insurance, mortgage insurance, flood insurance, and HOA, and they aren't buying the house poor, meaning should the AC go out in a month, can they fix it? Understanding debt to income ratio and buying a house that they can be very comfortable in the payment no matter where the market goes. Owning real estate always makes more sense than renting. Now, with those caveats in mind, is the payment more than comfortable no matter what happens to the equity? The whole idea of marry the house, date the rate, I don't subscribe to that. I'm a big fan of, I'm a big fan of, can you afford the payment today? If you can't, then it doesn't make sense to buy real estate.
Yeah. Thank you for bringing that up. You know, over the last few years, you've seen tons and tons and tons of agents, tons of lenders talk about marry the house, date the rate. They're all putting a ring on that rate. Rates have not fallen quick enough. Now, that doesn't mean they're not gonna fall in the future and they can't refinance in the future. But if you bought 2 years ago thinking you're gonna refinance in 6 months because rates are gonna crash, you're stuck in a mid-7 interest rate on a house far above what you can afford. So, not good advice. I don't think you'll ever see any piece of data out there with me subscribing to that kind of advice. It's not good advice.
Well, I don't think anyone who sold real estate in 2009, 10, 11, or 12 would ever say that. And if you are,
get out of real estate.
But and yet, in order to change the interest rate, you have to have equity. Like that's the misnomer in this, and that's why it's such a frustrating thing to hear somebody say, even on a stage. The only way you can refinance is if you have equity.
Or if you want to put that cash out of pocket, which is ultimately
defeats the purpose.
Defeating the purpose of saving yourself money.
Right, defeats the purpose. When buying real estate, we want to look at the two factors. Number one is, what is the out-of-pocket cost, which is what your question was. And then number two is, does the principal, interest, taxes, insurance, mortgage insurance if there is, flood insurance, and HOA should there be one, all fit into a nut that they are very comfortable as if they were renting? Out-of-pocket necessary based on the month's supply of inventory. Once we understand as a real estate agent that month's supply of inventory is in what's called a buyer's market, which means inventory is growing, and that the buyers have more leverage based on the amount of inventory, that concessions are a huge variable and a positive variable should the agent understand how to navigate the contract. And a seller concession is simply the seller conceding some of their proceeds to help the buyer with their closing costs. And the buyer just wraps this money into their loan over 15, 20, 30 years, whatever loan product they decide on. Mathematically, the loan officer like you would go through the process with them and help them decide if having a certain percent of the purchase price given back to them at closing or wrapped into their loan makes more sense than them taking it out of their pocket.
On that, so there's a couple ways seller concessions can be used. You could reduce your cash out of pocket by putting them towards your closing costs. You could also use it to get creative and buy down your interest rate further than you may have been planning. Buying down your interest rate is what we call in our world discount points. It's prepaid interest to secure a lower than market interest rate for the life of the loan. If you have seller concessions and you want to use them to secure a lower payment, there's ways to do that as well.
In other words, agent, loan officer partnership in helping their buyer, helping you, navigate the real estate market, navigate the contract, navigate the ways that they can save money.
And I want to be clear on this. No two clients are the same. So whatever works for Lee may not work for Danny. And the reality is that's okay. That's why working with a trusted lender that, again, has your best interest in mind is key. It's not about the type of loan we're doing. It's about the type of loan that we are doing that fits your life goals.
So let's talk about loan products.
Yep.
So the FHA is 3.5% down. VA, they've earned the right to have a 100% loan product. And that's a product that you specialize in.
100%.
And there's a USDA loan, which in South Florida, we don't have too many unless you go all the way south.
2 in my life.
And yet, that's a very low out-of-pocket loan.
It's a great loan in the right environment.
Absolutely.
Not very right environment here in sunny South Florida. But if you're outside of the Tri-County, the USDA loan is an unbelievable product.
Absolutely. So then there's conventional, which has, I believe, as low as a 97.3 or 3% down.
3% down for first-time homebuyers, 5% down for anybody else.
Let's use a 3% down program. So if a buyer's down payment is 3% and we're buying a $500,000 house, that would be a $15,000 down payment.
Yep.
And if a buyer's closing costs, that would be the costs associated with borrowing money. It would be getting clean title. It would be
Funding an escrow account.
Escrowing taxes and insurance. These costs could be upwards of 3-4%. If a buyer, you have $15,000 cash, or you can have a gift of $15,000 or any variation of, it's very possible in a buyer's market, a market where inventory is over 6 months, that a seller is willing to contribute towards their closing costs so that they could get into a $500,000 house with literally $15,000.
Yeah. And then depending on the situation, if it's coupled with another down payment assistance program or something like that, maybe even less.
In other words, there's down payment assistance programs. We call them DPA programs, down payment assistance, where that $15,000 could be even less.
We have programs that range from anywhere from $5,000 to $35,000. There are also city-specific programs that you can get upwards to $100,000, which we were able to just do for someone up in Palm Beach, so that was really cool. There's a lot of great down payment assistance programs out there for the right candidates.
What are some steps that a home buyer would want to explore should they want to navigate down payment assistance?
The very first step to the home buying process, regardless of what type of program you're doing, regardless of what type of loan you're taking out, the very first step is getting pre-approved. It's making sure you talk with a trusted lender that's going to review all of your information up front, so that way we can make sure that we place you into the right product. Every single product has its own criteria. All the down payment assistance programs have their own criteria on top of that. So each of them are different. They all have different credit score requirements. They all have different debt to income ratio requirements. Some of them have income caps. Before saying, hey, we can get you this down payment assistance, it's super important that you go through the pre-approval process the right way to make sure that the program actually exists for your situation.
So in other words, if someone's interested in the state of Florida for a down payment assistance type of home purchase, it would only make sense that they contact us,
100%.
you and myself, and we would help them navigate the best product, the path, what they need to do to apply, what the timeline would look like, and get the process started sooner rather than when they're behind the 8 ball of maybe their lease is expiring.
100%. And you know, some clients we'll talk to, and within 30 to 45 days, they're under contract and moving into their home. And some clients we talk to, and it's a 2-3 year process, and that's okay. That's what we're here for.
When buying and wanting to navigate, explore the down payment assistance programs, or qualifying for a loan to get the best deal for them, I've always recommended a 6-month process.
Yeah.
When you and I were preparing for this, you feel comfortable 90 days. And yet when I say 6 months, you're like, well, that makes sense because there's things that could come up. So give an example of why 6 months would be the right time to start the process should something come up, like what?
So we could pull your credit. There may be something reporting inaccurately that you're not aware of that could take a few months to reconcile. You may have some debts, you may have some old negative stuff on there that we've got to clean up. Some of that stuff takes time.
So if you're looking to purchase in the summer of 2026, it would make sense that in January, you sit down, go over your goals with a loan officer. Not that you're going to go looking at properties, but that you at least get clear on what might get in the way, what you can adjust to get a higher credit score to then be repulled a couple months down the road. Here's another super important idea as to why sooner the better, is because whenever a home buyer like you wants to look on websites like Zillow, Homes.com, KW.com, whatever sites you want to search, it would make sense that you know what they cost out of pocket and monthly payment. And the only way you can know is once you speak to a lender, roughly what the interest rate is today. And you can see, hey, interest rates today are 6.5 and you qualify for 6.5. And so if in 3 months interest rates are 6, you know you should qualify for roughly 6. And so when you're looking, you now can decide, hey, that house has a payment that I feel comfortable. I could go look in this area. I can look at this style of house. Or, hey, I really need to be just looking at townhouses or duplexes or a condo if that's what the comfort level is.
The reality is that 6 months is going to give you, me, and everybody else enough time to put together an accurate plan so you can go out there and make an educated decision, fall in love with the home that you can afford to buy and that you're comfortable making the payments on.
Like, subscribe, pass along, comment below. This is so much fun. Tell us what you want to see next. Dan, did you have fun today?
I had a blast.
Let's go.